Hi, class. We've been talking about managerial accounting and decision making, and we've talked about the kind of differences that you might have between accounting information produced according to financial accounting and the financial statements versus information that might be more useful for helping you make managerial decisions. So today we continue with these, and in particular, we're going to focus on the cost volume profit relationships. So what happens to cost as we produce and sell more, and how do we calculate the profit numbers? And in particular, we're going to be talking about things like break-even analysis, finding the point at which you just have enough revenue to pay all of your costs. And how do you find that? Is it affected? What is the effect of different decisions about whether to pay commissions or fixed wages and stuff like this? So let's take a closer look. So first of all, let's start with this company that produces billiard tables. And our company, let's say they're able to make between 4 to 10 pool tables. And they have had in the past some costs, which they have recorded, which allows us to estimate the actual relationship. So here they operate, 40-hour shift. They produce, up to 7 tables, and they may be able to produce up to 10 if they have their employees work overtime. And obviously, when you have overtime, you're going to have a higher wage applied as well. So the following table contains the total costs, fixed, variable, overtime, everything, including to produce between 4 and 10 tables. So if we have the number of tables being produced, and this is the cost, well, can we estimate the actual relationship? With some assumptions, yes, we can. So in a cost volume profit analysis, we want to try to determine how much is the total revenues, how much fixed and variable costs do we have, and together using either graphical solutions or using some type of formulas or equations, are we able to determine how much profit the company would be making. So some assumptions. Revenue changes in relation to production and sales. So we're going to be selling a certain quantity at a fixed price. So that's going to P times Q will give us the total revenues. Costs can be divided into variable and fixed element is constant over the relevant range that we have. In our example, it could be, the 4 to 7 or 4 to 10 tables. Revenues and costs behave in a linear fashion, so we're able to approximate, even if the actual cost structure was curvilinear, over a particular range of that, we're able to use a straight line to estimate how it's going to behave. Costs and prices are known. Okay, very good. If more than one product exists, the sales mix is constant. In our initial examples, we will be focusing on companies that produce and sell only one type of product. And in reality, companies typically have more than one type of product. So in that case, to be able to use our formulas that we develop here, we're going to assume that the percentage of one type of product to the other is remaining consistent over this range, in which case we are able to take what we're going to learn from our example and apply it to these others. In reality, if that percentage, if the sales mix is changing, then we may need a little more complicated, a little more detailed analyses, but it can be done. Inventories stay at the same level. We need this assumption so that our revenue and cost is going to depend on a quantity. Right? So if the inventory is staying at the same level, what is happening is that everything we're producing, we're selling. So the quantity that we use in determining total revenue, price times quantity, and the quantity that we use in determining our costs, fixed cost plus variable cost times the number produced and sold. In order to be able to use these equations together, we need to basically be selling everything that we're producing, so holding inventory constant. And ignoring the time value of money. So from the beginning of the period to the end of the period, if the discount rate isn't too big, this assumption can be valid. So everything we buy and sell during the year is said to be of equal value. And using these together, let's take a closer look. So first of all, we need to find out about something called the contribution margin. In the financial accounting, in an income statement, we would have things like sales minus cost of goods sold gives us our gross profit. And if we calculate that percentage, it would be the gross profit margin. But within the cost of goods sold, as we've discussed earlier, you would think that that is a variable cost, but there are some components like the rent of the factory or the depreciation of the equipment and so on, which may be fixed amounts. So taking the fixed out of that and only leaving in the variable cost for the company, we're able to obtain something called a contribution margin, which is basically equal to your total revenue minus your total variable costs. Or you can calculate a contribution margin per unit, in which case you are converting that to a percentage or to a per unit. You're able to sell it for this price. This is the variable cost, and the difference is what's left over after the variable cost, which actually you're going to be able to use to start paying off the fixed costs. So the difference between total revenue and total variable costs, or contribution margin per unit, the selling price per unit minus the variable cost per unit. Similarly, we can calculate this as a percentage, in which case take the contribution margin calculated above, divided by the selling price. So if we have the revenues and variable costs and the contribution margins for each unit, selling for $200, variable cost is $120, so we have a contribution margin per unit of $80. If we were able to produce and sell 2 units, our revenue becomes 2 times 200, 400. Our variable cost becomes 2 times 120, 240, and our contribution margin becomes 160. If we were to calculate this as a percentage, it's going to remain a constant percentage. So revenues make up 100%. Divide everything by the selling price. Variable costs are 60%. So 60% of the $200 unit selling price is for variable costs, meaning that 40% is left over as a contribution margin. So $80 per unit or 40% contribution margin percentage. So using this information, how can we use it to estimate what's going to be happening as the number of units changes? So basically, if we sell, 0, 1, 2, all the way up to 25 or 40 packages, and if the contribution margin is staying the same, what is it going to look like? Well, our revenues, if we sell 0, would be 0. Variable cost would also be 0. If they're truly variable, but our fixed cost would remain, right? So $2,000 here is our fixed cost. So if we don't sell anything, if we don't make any money, our loss for the period would be $2,000. Then as we start producing and selling items, what happens? Our revenue goes up $200 for each item that we produce and sell. Variable cost also starts to go up. So for each unit produced and sold 120, and $80 per unit contribution margin. So above the variable cost, we have $80 that we are making from each package that is sold. And if we produce and sell only 1 unit, in that case, we have $80, but we still have a fixed cost of $2,000. So we're still losing $1,920. And again, if we continue, if you sell 2 packages, revenue becomes 400, variable cost 2 times 120, 240, contribution margin 160, fixed cost remains the same. Our loss is getting smaller, but it's still minus 1,840. When you get to the point of selling exactly 25 packages, your revenue becomes 5,000, variable cost 3,000, and contribution margin becomes 2,000, which is just enough to pay the fixed costs. And you have a net operating income of $0, which means that you are breaking even. So we have found the point of break even. If this company is able to produce and sell exactly 25 packages of this product, they are able to break even. They're able to get by and not be losing any money. And if they continue to be able to increase their sales above the break-even point, then they begin making an actual positive profit. So, for example, if they were able to produce and sell 40 packages, revenue is 40 times 200, 8,000. The variable cost is 40 times 120, 4,800. And the contribution margin is 40 times 80, 3,200. So actually, we could have calculated this contribution margin without having to go all through these calculations. If we know that the contribution margin per unit is $80, then I could simply have done 40 times 80 and directly calculate this contribution margin. Minus the fixed costs means that 1,200 is left over as a net profit for this company. So we're making money. Could we find a formula to calculate the break-even point for a company? Yes. So here's the formulas. You can calculate the break-even point in actually two different ways. One of them is the contribution margin in dollars or Turkish liras. The other one is the break-even point in units of production and sales. So if you want the break-even point in units, what you need to do is take your fixed costs and divide it by the contribution margin per unit. So our example, we had a fixed cost of $2,000. We had a contribution margin per unit of 200 minus 120, $80. So 2,000 divided by $80 gives you 25 units. This is how many you need to sell to reach the break-even point. Once you have that point, if you want, you can multiply it by the selling price, $200, and you would find that 25 units basically means that your total revenue at that point is $5,000. But if you wanted to be able to calculate that break-even point in dollars directly, you could do this: fixed costs divided by the contribution margin percentage, right? Contribution margin percentage was 40% in our example. So 2,000 divided by 40% gives you $5,000. So this is, if you want to calculate the contribution margin directly in dollars, $5,000, this is how you calculate it. So you can use these formulas to quickly and easily give you the break-even points. And then in your company, is that an easy point to reach? You know, how frequently would you have it? Would you ever run the risk of not being able to reach it? It would allow you to analyze whether, you know, starting such a business makes sense or is it too risky. You would be generating a lot of information about this. So this information put onto a graph basically would look like this. So here, this is your total revenue line, and notice that it starts from the 0 point. Why? Because if you produce and sell zero, I don't care what your price is, your total revenue is going to be 0. So then where this line has a slope of 200. Why? For every unit sold, so one movement in this direction means that the total revenue goes up by 200. So this total revenue line is basically y is equal to 200x, 200 quantity. And on top of that, we have our total cost line. So this is your total cost. And over here, this distance at the intersection is your fixed cost, 2,000, and the slope of this line is your contribution margin per unit. Okay, so for every unit sold, you have a contribution. Excuse me, I take that back. The difference between the two is going to be the contribution margin. The slope of that line is actually your cost. Variable cost per unit was 120. So the slope of this is as production and sales go up 1, your costs go up by 120. So the total revenue is steeper because its slope is 200 per unit, whereas the total cost is only 120 per unit. So initially, up to the break-even point, the point where they intersect, this distance is actually when you're losing money. So this vertical distance is how much money you're losing at each of these sales level. If you sell 10 units, you're losing this much. If you sell 20 units, you're losing this much. If you sell 25, you have broken even. And then beyond this point is when you are making a profit. So a net operating profit, a positive net operating profit is what you have. And again, it's the vertical distance at any of these points. So you want to be over here. You don't want to be over here where you're losing money. So you want to analyze the break-even point to determine that, whether you're always going to be able to produce above this where you are creating a profit and you're not losing money in that early part of the chart. You might also say, well, I don't only want to know the point at which I break even, but maybe I want to be making at least, $1,000 or $5,000 or $10,000 operating profit. Well, in that case, this is called a target operating income. Okay, so if you want, let's say, to be making 1,000 operating profit or 10,000 operating profit, what you need to do is, first of all, if there are taxes involved and you care about your after-tax income, well, first of all, you need to determine how much after-tax income you want to have, and then you need to make it a gross amount by adding also the amount of taxes you would need to be paying. So for that, if your target net income is, I don't know, $1,000, divide that by 1 minus the tax rate you're going to have to pay. So this grosses up, adds the taxes you have to pay, and it creates your target operating income. And then if you want to determine how many units you need to sell or how much revenue you need to generate to be able to generate that operating income, what do? You take your fixed costs plus whatever target operating income you want to have and divide that by the contribution margin per unit. This will give you how many units you have to produce and sell. If you would like this number as a Turkish lira or dollar amount, in that case, fixed cost plus your target operating income again, but divide that by the contribution margin percentage, okay? And this will allow you to calculate your level of sales in units or your level of sales in dollars, Turkish lira, that you need to reach your target income, target profit. What else can you use? Well, you can also do something called sensitivity analysis. And this is kind of a what-if analysis. So what would happen if rather than sell this much, I'm able to sell this much, or my sales are down to this much? If my sales are 10% more or 10% less than expected, what happens? And if you want to make sure you're not losing money, then you may be conducting these types of sensitivity analysis. And this might also help you identify what are the things you need to focus on the most in order to make sure you don't have problems, that you don't go bankrupt. Okay, so for example, what will happen if to operating income, if the volume that you were estimating fails by 5%, is less than 5%? Or what happens if I was hoping to be able to buy or produce this for 100 lira each? What if I'm off by 10%? What if the costs ends up being 10% more than estimated? What effect will this have? So these are all types of sensitivity analyses that you may conduct. So it gives the management a better idea of what effect changes in certain of the factors that you are trying to manage will have on your profits. So among these, you could have, for example, choosing how you're going to compensate your salespeople. Okay. So, for example, sorry, this is about rental arrangements. So do you want to, for example, pay a fixed amount for renting the machines that you're going to be using in your factory? Or do you want to rent them with a variable cost? So rent them according to how many hours you use them or how many units you produce, maybe an alternative. So here, this is, if you have a $2,000 fixed payment that you're making, that's going to determine this point over here, right? And in that case, your break even is at 25 units. Another alternative might be to pay 1,400 fixed, but give them a percentage of the sales. So 5% commission might be another alternative. So what that's doing is that is changing your break-even point, but is also changing the slope of your cost. Now, the fixed cost is coming down, but the slope actually is going up. And what will be the net effect of reducing fixed cost by 600, but increasing your cost by 5%? And here we can determine graphically that the break even actually is coming down by 5 units, down to 20. Or what if we could pay totally based on commissions? So 0 fixed, but only based on the sales that they are generating. Well, in that case, break even is coming down to 0 because your fixed cost is disappearing and everything is becoming variable. But be careful in that when you're generating profits, like when you're selling, 20, 25, 50 units, the amount of profit that you have over here or even over here might be more than the profit you have over here. So the making everything variable cost is nice in that you don't lose money, but the profit you're making might be lower than you were hoping for. And that's a decision that you're going to have to make as a manager of this company. So let's take a look at some actual numbers. So here we have a company that makes bicycles, and they sell these bicycles for $500 each. And if the company is able to sell 500 bicycles for $500 each, what do we have? We have 250,000 of sales revenue, total revenue. If each bicycle costs us $300, then those 500 bicycles creates a variable cost of 150,000, which leaves a contribution margin of 100,000. So if the company has fixed expenses of 80,000, that means that our net operating income would be 100 minus 80, 20,000. So if we assume that this is within a variable and fixed range, relevant range, can we calculate the contribution margins and the per unit and the contribution margin ratios? Yes, we certainly can. So in this case, if we do it on a per unit basis, we notice that we sell each bicycle for 500 and the variable cost is 300, which means that the contribution margin per unit per bicycle is $200. So each additional bicycle that we sell brings us an additional operating income of 200. Then we can use this information to calculate a bunch of things quite quickly. For example, what is the break-even point? Well, remember the break-even point in units. What did we have to do? Take the fixed cost, which was fixed expense in this case was 80,000, divided by the contribution margin per unit, $80. That is going to give you how many bicycles you need to sell to break even. If you want that same break-even point, but you want it in dollars, then you would take the same $80,000 fixed cost divided by the contribution margin ratio, the percentage, which is basically contribution margin 200 divided by 500, so 40% contribution margin percentage ratio. So 80,000 divided by 40% would give you your sales revenue in order to break even in dollars. So let's Look at the calculations. So in order to break even 80,000, we need to sell 400 bicycles. 80,000 divided by $200 is equal to 400. So if we sell exactly 400 bikes, revenue 200,000, variable cost 400 times 300, 120,000, contribution margin 80,000. I could have told you this. Why? 400 bicycles, contribution margin per unit $200. Directly, you could have calculated the contribution margin as 80,000, and that is just enough to meet your fixed expenses. So your net income would be exactly zero, which is the definition of break even. So if you sell 400 bicycles, you have reached break even under these circumstances, under these conditions. If you're able to sell even one additional bike, how much would your net income be? Well, it's going to go up by the contribution margin per unit. So selling one more bicycle increases the sales revenue by 500, increases the variable cost by 300, increases the contribution margin by 200, which means that fixed costs don't change. So your net income or net operating income will go up by the 200 contribution margin per unit. Excuse me. That's where we are. So let's consider some alternatives. What if the company were able to sell 430 bicycles? Okay. Can we calculate how much our profit would be? Do we have to do the whole graphical version or all of the detail? Well, I can tell you. So for 430 bicycles, I know the break-even point is 400. So 30 bicycles above break-even multiplied by 200, then 6,000 will be your net operating income. And I could also tell you what your contribution margin total is going to be and all these others. So let's take a closer look. So here we have 400 for the different amounts. So, sorry, slight difference here. So revenue, cost, profit. If you had 300 versus 400 versus 500 units, what would the relationship look like? Well, we know this is break even. And if you sell 100 bikes less than break even, you should be losing 100 times the contribution margin. So 100 times 2,000 loss. If you sell 100 units more than break even, your profit will be 100 times the contribution margin per unit plus 20,000. So that's where we end up. If you want to do this graphically, sure, you can do that as well. So in a CVP, cost volume profit graph, we have the units of production and sales down here, and here we have the revenue and or the cost on the vertical axis. So your fixed expenses, here we have $80,000 fixed expense. Next, we have our total expenses. So the slope of this is, what was it, $300 per additional unit. And we have our total revenue or total sales starting from zero. And for each unit that you're selling, you are receiving $500 extra. So the slope is 500. And using this information, we can see our break even at 400, where total revenue is equal to total cost. And up to this point, we are losing money, breaking even at 400 units or $200,000 in sales. And beyond this point, we are making a profit. So this is how you could use a graph to understand how much money you're making or losing or where the break even is. Or we could be using the contribution margin or the contribution margin ratio, right? So contribution margin, 80,000 over your sales of 200,000. So 40%, you could be calculating this from the unit numbers as well. So what does this 40% mean? Every additional dollar of sales results in a net operating income increase of 40% of that, or 40 cents. So that's what we are going to have. On the other hand, a contribution margin ratio also basically means that we are able to, after paying our variable costs, we have left over 40% of the whatever sales revenue you generated. So that's what we have. So 400 to 500 bikes, $50,000 extra. 40% of that will be in contribution margin. And that means that your net operating income will also be increasing by that amount because fixed costs, as we know, are remaining fixed. So that's what we have. So 50,000 increase in sales increases contribution margin and operating income by 40% of the increase in sales, 20,000. So if you want the formulas, yes, contribution margin ratio, contribution margin over the sales number, or if you want to do it, contribution margin per unit over the unit selling price. Variable cost ratio would be 1 minus this. So the sum of these is equal to 1. And what kind of differences can this make? So what do we have? Let's think about this company where you're trying to sell coffee, espresso, on the street, and you have a little cart. The average selling price of a cup of coffee is $1.49. Average variable expense per cup is 0.36. Average fixed expense is 1,300. Okay. So if you expect to sell 2,100 cups each month on average, what is the contribution margin ratio for Coffee Klatch? So again, be careful. Contribution margin is one thing. Contribution margin per unit is one thing. And contribution margin ratio, again, is another thing. So here they want the contribution margin ratio. First of all, let's do this on a per unit basis. What is the contribution margin per unit? 149 selling price minus 36 cents variable cost. So 149 minus 36, 1.13. So $1.13 is your contribution margin per unit of coffee sold. And if you want the ratio of this, what do you need to do? 1.13 divided by the selling price of 149 would allow you to calculate what your contribution margin ratio is going to be. And if you do this analysis, so up top, 149 minus 36, this is 113 down here, divided by the selling price, gives you 75.8% contribution margin ratio. So B would be correct in this case. If we go on, what else can we examine? What would happen? So going back to the bicycle example, if racing can increase its unit sales from 500 to 540 bicycles by increasing advertising budget by $10,000. So we spend $10,000 and we are able to increase our sales by 40 bicycles. Assuming that the selling price doesn't change, could you tell me how much contribution margin this is going to create? 40 bicycles multiplied by the contribution margin per unit of $200 per bicycle. In that case, that basically tells me that I'm able to generate $8,000 additional dollars of revenue and as a result of profit. Sales would go up by 40 times 500, but the variable cost is going to go up. So the contribution margin of 200 is that difference, and 40 at 200 contribution margin means that my contribution margin is going up by $8,000, but it's costing me $10,000. So this is going to reduce your profits actually, right? So sales go from 500 to 540 bikes, revenue goes up, expenses go up, contribution margin increases by 8,000, but your fixed costs go up by that advertising expenditure of 10,000. So your net income actually goes down by 2,000. So I don't advise this company to undertake this as advertising because it's not creating sufficient return, sufficient contribution margin. So don't do it. You'll be better off. And again, the shortcut would simply have been the contribution margin, 40 units at 200, 8,000 is created, but the cost is 10,000. So you're losing operating income of 2,000 by undertaking this decision. So don't do it. What else could happen? What if the company decides to use more high quality raw materials? And this would increase costs per unit by $10. So the 300 variable cost basically is going to go up to 310. But what if this higher quality bicycle can, if you're still selling it for $500, what if your sales are going to go up by 80 units? Okay, so is this a meaningful thing to do? Produce higher quality bicycles, still sell them at the same price, but it brings in additional customers. What is the net effect going to be on this? Well, in order to do this analysis, notice that the number of bicycles goes from 500 to 580. So your sales revenue goes from 250 to 290. Variable expenses still 300, it used to be per bicycle, now becoming 310 per bicycle. So it doesn't just go up 80 times 300, but it goes up by 80 times 80 times 310 plus the initial bicycles, also their price going up. So the variable expense per bicycle has become $310. So 580 times 310 is the new variable expense. Contribution margin used to be 100,000. It has now become 110,200. How do we calculate this? Well, what is the new contribution margin? It is 500 minus 310. So contribution margin per unit used to be 200. Under the new case, it has just become 190 per bicycle. So I could have told you that the contribution margin is going to be 110,200 by saying, hey, 580 times 190 is what will give you this 110,200. And if your fixed expenses have not changed, what this ends up creating is net income goes from 20,000 up to 30,200. So increasing your expenses by $10 per unit by creating additional demand and causing the number of bicycles sold to go up to 580,000 actually creates a lot of additional sales, which ends up creating additional net operating income. So this decision overall has been quite beneficial, is what we have. Yes. What else? So what happens to profit if racing cuts its selling price by $20 per unit? Okay, so the selling price is going to go from 500 down to 480, increases advertising budget by 15,000 per month. So fixed costs are going to go from 80,000 up to 95,000. And 3, increases unit sales from 600 to 650 per month. So the lower price and additional advertising increases sales by 150. So all of these 3 happening together, what effect will this have on our profits? So let's go through the steps. This was under the original conditions, 500 bikes selling for 500 each at a cost of 300 each with fixed costs of 80,000. We had a profit of 20,000. Now, new conditions. You're selling bicycles for $480, but you're selling 650 bikes. So the variable expense is 650 times, so let me look back. So yes, the cost isn't changing. So it's still 650 bikes times $300 for the variable cost, which means a contribution margin of 117,000. I could have also calculated this. And the new contribution margin is how much? 480 minus 300. So 180 is the contribution margin per unit under the new conditions. So 650 times 180 should be giving you this contribution margin. Then minus fixed expenses. They were 80,000. They've become 95,000 because of the additional advertising, meaning that the net operating income left over after the new fixed costs are also taken into account gives us a net operating income of 22,000. So overall effect has been to increase net operating income by 2,000. That seems like a lot of changes, a lot of work for just slightly more profit. Okay, but the overall effect, expected effect, is to increase your sales a lot, but because your selling price is a little lower, your contribution margin becomes lower, and with the additional advertising you needed, the total effect on profit is slightly, just a little more profit than before. Okay, so some more changes. What is the profit impact if racing pays $15 sales commission per bicycle sold instead of paying salespersons flat salaries that currently total $6,000 per month? So remember, we had total fixed costs of $80,000. Apparently $6,000 of that was from salespeople's salaries. So they're saying, let's get rid of this $6,000 salaries, fixed cost, but we're going to add $15 per bicycle sold as a sales commission. If this allows the company, its salespeople are going to be more motivated to sell. If the number of bicycles sold increases from 500 to 575, is this going to help or harm the company? Let's look at the changes. So basically, the contribution margin is going to be changing from $200, 500 minus 300, to 500 minus 315. So the new contribution margin per unit is actually becoming 185, down from 200. So we can basically say 500 times 200 was the old contribution margin. The new contribution margin is going to become 575 times 180. And you can do it in steps if you'd like, or you can do the calculation directly. But the contribution margin used to be 500 times 200, 100,000. Now it's become 575 times 100 and what was it? $115 increase. So the contribution margin goes down by $15, 185. So 575 times 185 will give you this contribution margin. And fixed expenses had gone from 80 down to 74. So the total effect on net operating income is actually to increase net income by over 12,000. Okay. Part of this comes from the higher sales and as a result, higher contribution margin. But the rest of it comes from, less expenses. So that's where we are. If racing has an opportunity to sell 150 bikes to a wholesaler without disturbing sales to other customers or fixed expenses, what price would it quote to the wholesaler if it wants to increase monthly profits by 3,000? So this is a combination, and it's interesting. This person is going to take these bicycles maybe to another city or to another country, so it's not going to affect your existing sales. So that part of the business remains the same, but they want to buy 150 bicycles and take these away and sell them in another market, and it doesn't bother you. But they're probably going to ask for a special pricing. They don't want to pay 500 per bicycle Or if they do, great, sell to them for that price. But if you would like to be making an extra $3,000 on this additional sale, how could you calculate this? Well, let's do the calculation. If we want to make an extra $3,000 from the 150 additional bicycles that we're selling, basically, we want to be making $20 per bicycle that we sell. So if the original variable cost had been costing us 300, if we're able to sell those bicycles for 320, hey, all of a sudden, we are meeting our additional profit target of $3,000 extra if we're able to sell just those new bicycles for 320 each, as opposed to selling them for 500. So it's a big discount. But again, remember, they're taking these bicycles and they're going to sell them in a totally different market, is the assumption. So 150 bikes at 320 per bike cost you 48,000 revenue, additional revenue, and it cost you 45,000 to make them, leaving net operating income of 3,000 addition to your pockets. Okay, and then let's do a few example questions to kind of finish up what we want to take a look at. So break-even analysis, yes, we've seen that it can be done by using the equations, or contribution margins typically gives you the results in a much quicker fashion. So let's go ahead and see what it looks like. The equation methods, basically, you have your profit, which is basically equal to your total revenue, your contribution margin, sales, total revenue minus variable costs. So this is your contribution margin minus fixed expenses. So this is your profit function. Or from this, you're able to extract the sales figure, and basically it tells you sales are equal to variable expenses plus fixed expenses, so total expenses, plus any profits you're making, right? And if you set profits equal to 0, when sales is equal to, or revenue is equal to total costs, you're at break even. So that is the kind of equation way to approach this problem. So from the bike company example, we had this company selling bicycles for 500 each and a variable cost of 300 each and a contribution margin of 200 each, or in percentages. So converting this into an equation will make it look like this. Sales are equal to price times quantity, so 500 times quantity. Your variable cost will be 300 times quantity. Your fixed expenses will be 80,000. And if you set profits equal to 0 and solve for Q, that gives you your break-even point. In Q, in units sold, number of bicycles sold. Okay, so that is what you would do to solve for the number of bicycles that you need to sell. You could multiply that by the selling price to give you the break-even point in dollars, or a number of other things that you want as well. But if you want to do it directly from the equation, kind of change things around so that your sales number is equal to variable expenses plus fixed expenses plus profits, but state your variable expenses as basically 60% of sales. Okay, so sales, if it is equal to X, your variable expenses are going to be 60% of X. And your fixed expense is 80,000. So solving for X would allow you to calculate directly your break-even point in dollars of sales. What mistake did I make? Yes, break-even point in sales dollars. And yes, solving for X in that case, $200,000 of sales would give you your break-even point. So yes, basically fixed expenses divided by the contribution margin ratio. So, that would be a shortcut to doing this. So again, If you're solving questions and you want to do it quickly, just use the formulas. You don't have to derive them every single time. Break-even point in units is equal to fixed expenses divided by contribution margin per unit. If you want that same break-even point, but you want it in dollars or Turkish lira, take your fixed expenses divided by the contribution margin ratio. And that will give you your break-even point in dollars. If you have a particular target operating income, fixed expenses on top of that adds how much profit you want to make. And again, dividing by these will allow you to find those points. Okay, so for our company, $80,000 divided by 40%, 200,000 break-even sales could be calculated easy. Let's do this for the coffee company, right? So we had the same coffee company. What is the break-even point? And again, if you want to calculate it in cups or in dollars, you can do it. But they want it. What is the break-even sales in units? Units here being cups. So what is your fixed expense? 1,300. What is your contribution margin per unit? 1.13, right? So 149 minus 36 cents, 1.13. So dividing 1,300 by 1.13 would allow you to calculate that you need to sell 1,150 cups to break even. Okay, so D would be the answer. If break-even sales in dollars, well, you can do it both ways, right? You know, 1,150 cups, multiply that by 1.49, the selling price would give you the break-even point in dollars. Or if you want to do it with a formula directly, again, fixed expenses, $1,300 divided by contribution margin ratio. So 113 over 149 would allow you to calculate the contribution margin ratio of 0.758 or 75.8%. So 1,300 over that gives you the break-even point in sales dollars, 1,715. That's where we are. So again, if you want the equations, take a look at this and how you would do the analysis. Yeah. So coming back to what if you don't want just a break-even point, but you have a certain level of profits that you want to generate. So a racing bicycle company wants to know how many bikes must be sold to have a profit of $100,000. And again, we have information, fixed expense of $80,000 plus profits of $100,000. So I need to have a total of contribution margin equal to $180,000. So 200Q is the contribution margin, 180,000 equality. Solving for Q, if you sell 900 bicycles, you will have exactly 100,000 of profits on top of your fixed expenses. And again, you could have solved it this way as well. Fixed expenses plus your target profit divided by contribution margin per unit. Very quickly, you could have calculated the 900 bicycles in this way as well. Then looking for it here, how many cups of coffee would have to be sold to attain a target profit of $2,500 per month? Okay, so you could do trial and error until you find the point at which you have a net profit of 2,500, or simply do 1,300 fixed expenses plus 2,500, so a total of 3,800 divided by you want it in cups, so divided by the contribution margin per unit of 1.13, and that would give you here 1,300 plus 2,500, 3,800 divided by 1.13, it tells you that you need to sell 3,363 cups in order to have achieve that target profit that we wanted. So 3,363 cups. If you sell it, you will be able to pay off your fixed expense plus have $2,500 of profit left over per month. And then last thing we will talk about is a margin of safety. How happy am I? You know, how much could sales go down and I would still not be losing money? If we examine this, so the excess of target sales above break even. So the margin of safety is basically your current sales level minus how much you would have to sell to just break even. And for our bike company, basically you plan on selling 500 bicycles per month and 400 was your break even. So even if sales go down by $50,000, you are still at break even. You're still not losing money. So you have in dollars, you can say your margin of safety is $50,000, or you can convert that to a percentage, which might be easier to compare. And you could say 50,000 over 250,000, 20%. You have a margin of safety of 20%. Even if your sales are 20% less than what you estimate, you still are not losing money. So that kind of is a measure of how confident you are in your job that you're not going to be losing money. And if we apply that, you know, to if you want the margin of safety in bicycles, yeah, you could sell 100 less bicycles than you're hoping and still be able to not lose money, is another way to look at this. And again, if you want the formulas, take a look at this. And, you know, let's apply it to the coffee example as well. So you expect to sell 2,100 cups. What is the margin of safety? If you remember what the break-even point was, right? How many cups did we have to sell? 1,300 divided by 1.13 had been giving us that number. So we basically are safe by 950 cups. We could sell many less than 2,100. So here we have, what was the break-even? Break-even sales was 1,150 cups. So that's 1,300 divided by 1.13. So that means that we are selling 950 cups more than break-even. So our sales could go down almost 50%, well, 45% exactly, and we would still not be losing money. So that's your margin of safety calculation. And I will stop here. The rest of this presentation, you can also download it from the class website. Then we go on and look at the cost structure of the company, how much of the costs are fixed versus how much are variable. This is referred to as operating leverage, degree of operating leverage. So larger factories compared to smaller factories are said to have a higher operating leverage. They have more fixed costs, but lower variable costs. And so if you are able to sell in very large volumes, those big factories make sense because your variable cost per unit will be lower. But if there's a chance that you're not going to be able to produce and sell very much, that big factory, those big fixed expenses may cause you to go bankrupt. So whether you want a large store with a lot of operating leverage or a small store, small factory with low fixed costs, depends on your expectations about the sales level. So that will be in another presentation. I hope you've enjoyed today's topic. I will see you in class.